Now let's bring into the stream Michael Jones. He is Caravel Concepts chairman and CEO. This firm prides itself on bringing its client base peace of mind, investors. And I wanted to ask you a question about that because you point out to your clients that the combination of Janet Yellen and at the Treasury and Jerome Powell at the Fed will be a match made in market heaven next year. How does your client base and the rest of us benefit from that?
Well, we believe that market bubbles are created when a wave of liquidity hits, a wave of newly printed money hits a fundamental rationale for an economic growth and for higher asset prices. And we believe that in 2020, we had the wave of liquidity. The Fed printed over $3 trillion, but we didn't have the economic growth because of the pandemic. That meant we had a great rally, but we didn't have a bubble. As we move into 2021, the combination of Jerome Powell at the Fed and the combination of Janet Yellen at the Treasury means that we think we get both elements of a bubble in 2021. We get another wave of money printing from the Fed to finance more stimulus. We get a real economic recovery, which helps that fundamental rationale, and we get explosive growth in corporate earnings. That creates that fundamental driver for higher asset prices that meets that wave of liquidity. And importantly, we don't think either Jerome Powell or Janet Yellen are in any mood to deflate a bubble if it emerges. And that means that if asset prices start really inflating, that a bubble could inflate bigger and last longer than any that we've seen in history.
So, Michael, with all of that in mind, where are you adding exposure? How should investors then be positioned here at this point?
So I think first place is where you should not be positioned. And I would say that's in bonds. Right now, we're still very close to all-time lows. And I think the kind of conditions we're seeing in 2021, Jerome Powell may look through short-term blips in inflation. He may use his average inflation targeting rationale to ignore any inflationary pressures. Long-term bond investors may not. So we see rising interest rates as a definite possibility for 2021, but that will be more than offset in the equity markets by rising earnings. We particularly see some earnings power in the banking sector. We think that banks have over-reserved for COVID-19, and we think they could have some earnings releases, and rising interest rates and a steeper yield curve will be really good for them. We are also really excited. We think all this money printing is putting downward pressure on the dollar. That's really creating nice opportunities in international stocks. Europe and Japan have recently been big outperformers. We think that can continue in 2021.
So you also say, in addition to buy the banks, that high-quality dividend stocks, X-Energy, we know what happened with ExxonMobil and Royal Dutch Shell, but that income's going to be a scarce commodity in 2021. The banks right now, the regulators are crimping their ability to pay those dividends. Are you anticipating a release next year?
I think that we will see a lot of regulatory relief in the banking sector once it becomes clear that the COVID vaccines are starting to return economic growth. Once you've got a better underpinning in the economy, I think regulators are going to look at the massive reserve buildup that happened in banks in 2020, and they're going to recognize that some of that isn't going to be needed. And I think they're going to allow dividend increases and reserve releases as we move into the back of 2020. That will be particularly, I think, allowed from a regulatory perspective if bank earnings start taking off because the yield curve is steepening and they're getting a better net interest margin.
All right, Michael Jones,
Bank
one
of
thing
America.
we talked about at the beginning of the show was that Wells Fargo, Charlie Scharf, actually alluded to what you just said, but perhaps in next year. But we have to say thank you, Michael Jones from Caravel Concepts, chairman and CEO. All the best to you.